Mirror, mirror on the wall, what's the safest investment of them all? If you were to ask people around the world that question, in general, folks would say U.S. Treasuries. So, what happens when the value of U.S. Treasuries takes a shock and goes down? What caused that? And what does it mean to us? And more importantly, how does it inform how we should be thinking about our future? Let's jump in and see, because just recently, U.S. Treasuries had one of their biggest shocks in over a decade. So let's find out what happened. Okay, we're going to start off with Reuters here. And the article is called What Just Happened in the U.S. Treasury Market. And the first line here is, in short, the U.S. Treasury market, a central pillar of the global financial system, came under heavy selling pressure, sending the 10-year borrowing costs surging. And when the costs surge, what that means is the price of the bond went down. At one point, the 10-year bond yields were set for their biggest weekly jump in more than a decade. Again, that's bad for the prices. So Reuters goes on to ask the question, why do we care? And we care because not only does the U.S. government face higher borrowing costs if there's a bond sell-off, but those increases also filter across the mortgages and corporate loans, spreading the economic damage around the United States and, frankly, potentially around the world. The Reuters article goes on to say, investors and analysts liken this week's move to the frantic dash for cash that happened in March of 2020, the first initial scary days of the pandemic, when the crash in the Treasury market forced the Federal Reserve to step in with a massive $1.6 trillion bond buying rescue. So when this happens, the U.S. government pays attention, the Treasury Department pays attention, the Federal Reserve pays attention, and you know what? So does the President of the United States. There are rumors that the reason for the 90-day pause was because on tariffs was because of what happened in the bond market. Okay, so the question is, what caused this now? And for that, I want to go to CNBC. Their article is called Trump Tariffs Drove a Treasury Sell-Off. Who sold the safe haven asset? And so this chart first shows us who is the biggest borrower of, or buyer, I should say, of U.S. Treasuries. The government is the borrower. And a lot of people would say China. And China's a really good guess, but you know what? Japan by far has more U.S. Treasuries that they hold, that they invest in, than China. And you can see the United Kingdom is very close behind China. So the UK is also close. And then Luxembourg, surprisingly. Look at this list. The Cayman Islands comes in behind that, Belgium, Canada. So there's some countries there that you wouldn't expect to have such large reserves of U.S. Treasuries. And why they do is a subject for another time. But essentially, they have need for U.S. dollars. And so that's why they would have such a big reserve. Okay, so is it Japan? Is it China? Let's start off first with China. And the subheading here is China shooting themselves in the foot? And they have a quote here from the chief strategy of Alpine Micro. I think China is actually weaponizing the Treasury holdings already, said one person. Another person said China selling down U.S. Treasury holdings would effectively be shooting themselves in the foot. That was Michael Brown, who's a senior research strategist at Pepperstone. China selling down treasuries would necessitate capital being moved back into Beijing and spark an appreciation in the yuan. And that is the precise opposite of what Beijing wants, especially at a time that the government's hoping to stimulate the domestic economy to cushion the blow from the tariffs. They want to stimulate their local economy to get their consumers buying more of the goods that are produced in China. That's one of the challenges, is the Chinese citizens are much better at saving money than us, and that's a good thing. But the negative for the Chinese government is people aren't buying the goods and services that are being produced in China, and so they're exporting it, which is one of the reasons that trade deficit with China is so stark. Okay, the CNBC article goes on to say, could it be Japan's life insurers? One analyst flagged that Japan could actually be the bigger culprit in the Treasury sell-off instead of China. Japan is actually the bigger problem, more specifically, Japan's life insurance companies. Now, the Japanese government has said, hey, we're going to hold on to our treasuries, but the Japanese government doesn't own the bulk of those treasuries. Those are owned by life insurance companies. Um, and this analyst goes on to say it's all very well for the Japanese government to say we're not going to sell U.S. treasuries, but it's not the Japanese government that owns them. It's Nippon Life. Okay, so we've talked about China. We've talked about Japan life insurance companies. Another thing could be is these algorithmic trading, these hedge funds that are doing quote unquote sophisticated trades. Could the hedge funds and the bond vigilantes be driving this? And going back to the CNBC article, as the bond sell-off gained pace, hedge funds could have been forced to unwind bond basis trades, which in turn add more fuel to the seller. Now, why don't we know? Why am I saying, is it China? Is it the life insurance companies? Is it hedge funds? The reason we don't know is, going back to the CNBC article, monthly Treasury data usually comes with a lag, and the most recent figures released in March are from January. So the transactions that took place in January were just available in March. So April's data is slated to be released only in June, so we still have some time until we'll find that. Given the scale of the sell-off and the lack of the clear and immediate figures, it's not easy to isolate specific parties driving it and to what degree, market watchers told CNBC. Okay, so what does this mean to you and I? What it means is there are things called black swan events, things that aren't supposed to happen, do happen. And just looking at our last 20 years, boy, there's a lot of things that aren't supposed to happen except once in 100 years that seem to be happening every 8 or 10 years, right? The great financial crisis was, many people would say, a black swan event. COVID, the last pandemic had been over 100 years ago, or over 100 years ago. So there's these black swan events that happen. So what does it mean to you and I when risk that aren't supposed to actually come into being are happening more often? And what that means is having a balanced portfolio, having our long-term asset allocation is more important now than it has ever been. So having that diversification and thinking ahead of time and being proactive and say, could I withstand a 30% drop, a 40% drop in my portfolio? And if the answer to that is no, then think about your asset allocation today and how could you protect yourself so that if that does happen in the future, you've done that work, because when the time comes, it's too late. So if you like this video, if you like videos about making good decisions for your personal finance and preparing for retirement, the YouTube algorithm says this is the next video of mine that you should watch. Thanks for watching this one. I'll see you in the next one. Bye-bye.